I want to draw your attention to the language being used by Minister of Finance Freeland on April 16th, 2024. And she said, the government is asking the wealthiest Canadians to pay their fair share. Another quote that she said is, we are asking the wealthiest Canadians to pay just a little bit more so that we can make investments and ensure a fair chance for every generation. The government has been saying the same thing for hundreds of years. But does this sound like the budget will balance itself? After reviewing the tax measures and proposals announced in Budget 2024, I wanted to make some specific comments about capital gains and the changes coming, despite the budget not including any increases to both personal or corporate tax rates. There are some indirect changes that are happening that will affect all Canadians. And why would all Canadians be affected by these changes that are only supposedly affecting the top 1% wealthy? Because this will have a ripple effect through all layers of the economy. The capital gains inclusion rate is increasing from 50% to 66 2/3% for any gain realized for individuals over $250,000 effective June 25th, 2024. For corporations and trusts, for all capital gains, the amount included that you'll have to pay tax on rises from 50% today to 66 2/3%. That's a 33% increase. What's fundamentally important about this is that there is no grandfathering date. So all embedded capital gains for individuals, corporations, or trusts will be affected by this rise in inclusion rates. Have the tax professional run an analysis on whether it's better to do a freeze now or perhaps wait. We never know what the next elected administration in this country is going to do in terms of lowering back these inclusion rates. While it's important that the budget did include an increase to the personal exemption limits, the lifetime capital gains exemption limit, the LCGE, to people selling eligible property, that's only for a qualified small business corporation or Fisher Farm property. All capital gains on stocks and other securities and portfolios, unqualified corporation investments, or corporations that have maybe owned property or commercial property for a long time are all going to be affected by this increase in the inclusion rate. Increasing this inclusion rate at the same time that the Bank of Canada is calling for a red alert, an alarm bell to be sound on the state of the productivity, the struggling productivity of the Canadian economy, will be a double whammy for both foreign and domestic investors. These new capital gains rates are a disincentive to invest in Canada in capital gains properties. And foreign and domestic investors, they want stability and assurance that their returns are not going to be eaten up by punitive tax rates. Investments coming from both foreign and domestic sources are a crucial part of the Canadian economy, driving manufacturing, business expansion, jobs, mineral exploration, and all these are going to be a factor in the economy in the years ahead. It's quite possible that investors will be driven away to more tax-favorable jurisdictions, or jurisdictions where, when we compare the growth rates of the economy comparatively to the US, the Canadian economy is stalling. And many people will go to the US to invest their money in a growing economy with more favorable tax consequences. Although Minister Freeland suggests that it's only a small amount of Canadians that are going to be affected by these capital gains inclusion rate changes, anybody with a rental property or second property, a cabin, a recreation property, are all going to be affected by these changes. If you'd like to know more about sound money, Austrian economics, and how you can create more wealth more efficiently, visit us at IBCanada Group.com.